Okay, let's unpack this. We're talking about one of the biggest financial decisions anyone makes. Getting a mortgage, buying a home. The whole lending world is just it's famously complex. It throws all these acronyms at you, FHA, VA, GSE, until your head starts to spin.
It's a system that, it really rewards the informed and can penalize you if you're overwhelmed. So today, our deep dive is into that very structure, into the strategy of home financing. We're pulling out the key takeaways from materials provided by a specific financial partner, Ace Mortgage Loan Corp. In Coral Springs, Florida. And they've been around since 1996, so we're going to look at what they claim about their service and their products.
Absolutely. So our mission here is pretty clear. We're going to cut through the jargon, understand the basic mortgage options out there. But I think more importantly, we need to look at the value of really personalized guidance in a process that can feel so impersonal. And there's a big one, a critical regulatory warning in their materials that could change things for a lot of people very soon.
Right. We're aiming to give you the knowledge you need to feel genuinely confident, not just superficially briefed when you start this process. It's all about understanding those little trade-offs
Yeah.
and knowing where you might have some leverage.
So looking at their materials, the philosophy they're pushing it's immediately obvious. They call it relationship banking. This isn't just a transaction. They're selling a deep commitment and I think availability.
The availability claims are what really jump out. You have to analyze them. They say they're available 7 days a week, 9 a.m. to 9 p.m. for, and this is a quote, accurate approvals and pre-approvals. Okay. But then they sort of double down. They promise 247 accessibility for clear and concise answers.
That sounds incredible on paper. I mean, you think about how often the anxiety of buying a home hits you after 5 p.m. or on a weekend. But, let's be realistic. Who is actually picking up the phone at 3 in the morning on a Sunday? And can they give you real advice, or are they just, taking a message? It almost sounds too good to be true.
Well, it's a powerful differentiator if they can pull it off.
Yeah.
I mean, think about it. If you have an urgent question about a document or some hurdle in your application, and they can actually deliver on that 24/7 promise, that would radically reduce a borrower's stress. It implies a huge commitment from their staff.
And that commitment seems to extend to a whole array of financial services. It's not just, here's a loan for your house.
That's right. Purchase financing is the base, of course, but they clearly service the whole home life cycle. Refinancing, for instance, whether you want to lower your rate or tap into your equity. And they also offer solutions for investment properties, even commercial financing. It suggests they're not just focused on your average first-time homebuyer.
And when you say tapping into existing equity, that's the cash out option they mentioned. That's a tool I think a lot of people forget about. What's the typical use case for that?
A cash-out refi is a really powerful tool. It lets a homeowner pull out some of their equity for, big strategic expenses, things like major home renovations or consolidating high-interest debt like credit cards. You're basically turning your home's wealth into cash you can use, often at a much better interest rate.
And for people who are just trying to get in the door, the down payment is always the biggest hurdle. The material is very specific about some solutions.
Exactly. They highlight two key things. First is 96.5% financing. That's a critical number. It means you only need a 3.5% down payment. Now, that's the standard for an FHA loan, but when they highlight it, it shows they're pushing every possible low down payment option for people who have good credit, but maybe not a lot of cash saved up.
And the second hurdle, closing costs, they address that directly with seller and lender concessions. What's the insight there?
Closing costs can be a real shock. We're talking thousands of dollars on top of your down payment. The fact that they're focused on helping you get concessions means they're actively strategizing to lower how much cash you need to bring to the table. Getting the seller or even the lender to cover some of those fees can be the difference between closing the deal and walking away. It's where expertise really pays off.
Okay, so we get the philosophy. Let's dig into the actual menu of products. Navigating these loan types can feel pretty dizzying.
It can be, but understanding the trade-offs is where you gain the real power. Let's start with the anchors of the market, the fixed rate and the adjustable rate mortgage.
Right. A fixed rate mortgage is all about predictability. You lock in a rate, and that's your rate for the next 15 or maybe 30 years. Simple.
And that stability is priceless for anyone who plans to stay in their home long term, or just for people who can't stomach the idea of their payment changing.
Yeah.
But, that stability usually costs a little more in the initial interest rate compared to an ARM.
Which brings us to the adjustable rate mortgage, or ARM. This one gives you flexibility, right? A lower rate to start, but then there's the risk it'll adjust later on. Who's the right person for an ARM?
ARMs are really strategic tools. They're best for someone who's financially savvy, who maybe plans to sell or refinance before that first adjustment period hits. Think investors, or someone who knows for a fact their income is about to jump significantly. For most long-term homeowners, the fixed rate is probably the safer play.
Okay, let's shift to the government-backed loans, FHA loans. The big idea here is making homeownership more accessible, right?
Accessibility is their whole reason for being. FHA loans are insured by the government, which lets lenders approve people with lower credit scores and, of course, that minimum 3.5% down payment. They open the door for a lot of people.
Yeah.
But, and this is a big but, we have to talk about the cost, the mortgage insurance premium, or MIP.
This is a huge point, and I feel like it gets glossed over. You get in easier, but you pay for it every single month.
Precisely. And unlike private mortgage insurance, PMI, on a conventional loan, which usually falls off once you have about 20% equity.
The FHA's MIP, it sticks around.
It often sticks with you for the entire life of the loan. So while FHA gets you in the door, you're trading that ease for a permanent extra monthly cost unless you refinance out of it later. That's the nuance you need to know.
And then you have the foundation of the whole market, the conventional loans backed by Fannie Mae and Freddie Mac.
These are the benchmark products. They reward you for having a strong credit profile. If you have great credit, they offer fantastic rates. And this is critical. If you can put down 20%, you avoid mortgage insurance altogether. Huge savings over FHA in the long run.
Now, what about the specialty loans? The source material goes into detail on VA loans. The benefits for veterans and active duty military seem, well, substantial.
The VA loan is probably the single most powerful mortgage product out there. It offers 100% financing. That means zero down payment. And crucially, no private mortgage insurance. That combination is just colossal savings both upfront and every single month.
But just to keep things balanced, there is something called the VA funding fee, right?
Correct. It's a one-time fee, usually a percentage of the loan amount, and it helps keep the program funded. You can also always roll it into the loan itself, so it's not cash out of pocket, but it is a cost. Still, even with that fee, the VA loan is just exceptionally good because of the no PMI savings.
And finally, what about the high end of the market? The jumbo loans.
Jumbo loans are a different animal entirely. The material calls them private equity or portfolio loans. Because a private investor is holding the risk, not the government, the rules can be a lot more flexible. This is key for, say, high net worth buyers or real estate investors.
Flexible in what way? What does that actually mean for a borrower?
It means the lender can look beyond just your W-2 and your credit score. For an investor, maybe they look at your asset statements or your existing properties. It allows for things like faster closings and terms that a standard conventional loan just can't match.
Okay, so we've got the product menu down, but a real deep dive has to look at the forces shaping that menu. Let's talk about the regulatory side.
Well, you have to start with the Consumer Protection Financial Bureau, the CFPB. This is the agency that regulates lending, from mortgages to credit cards, to make sure it's fair for you, the consumer. And their involvement is why the source material sounds a major alarm bell.
Let's get into the weeds here for a second, because this is a really vital insight. The source material warns about the CFPB pushing to eliminate the GSE patch. What in the world is the GSE patch, and why should we care?
This is a critical point. The GSE patch is basically a regulatory exception. It allowed lenders to be a bit more flexible when calculating a borrower's debt-to-income ratio, their DTI, for conventional loans.
So if the patch goes away, lenders have to be much stricter about how much debt you can have relative to your income.
Exactly. And the source warns there's a hard deadline coming down the pike, and that getting rid of it will have a tremendous effect on consumers' ability to purchase or refinance. What that means is a lot of borrowers who might have qualified under the patch, especially people with moderate incomes in pricey areas, could suddenly be denied a loan. It just shrinks the pool of buyers overnight.
Wow, that's something you absolutely need to know if you're planning to buy a home in the next year. Now let's pivot to something more personal. The article they have called "But My Neighbor Got," this gets into the myth that interest rates are one size fits all.
It does a great job of just dismantling that idea. The notion that a banker just picks a rate for you is, well, it's wrong. Macroeconomics sets the baseline, the Fed, the bond market, but the final rate you get is intensely personal.
And it's more than just your credit score, right? What else goes into it?
Oh, there's a whole list. It's the loan purpose. A simple refinance usually gets a better rate than a cash-out one. It's the occupancy. You'll pay more for an investment property than your primary home. And even the property type itself. A single-family home is often priced better than a condo. That's why comparing your rate to your neighbors is just pointless. You're comparing apples and oranges.
Which brings us to the last reality check from the article, Are We Closing Tomorrow? You imagine closing day as this big celebration, but they paint a much more stressful picture.
Yeah, they get very real. They describe that dreaded call after weeks of work where you hear, "You're not closing tomorrow." They say it creates dead silence followed by internal rage. It's an admission that this is a complex process and last-minute delays, a title issue, a funding problem, they happen. And that really underscores why that personalized 24/7 support they claim to offer is so important.
Right. If the whole system is that complex, the human element, the person you can call, becomes everything. And the client testimonials in the material, they really bring that relationship banking idea to life.
You see clear examples of them using specialized knowledge for specific people, like Miriam M., a Florida teacher who used the Hometown Hero Grant Initiative. That's not just filling out forms. That's knowing about and using local programs to help someone.
And the commitment to veterans comes through again with Margaret F. She specifically mentioned how much she valued their deep knowledge of VA home loans and that she got a terrific rate. The insight there is she said they made a bureaucratic process feel simple. That's what expertise does.
But maybe the most powerful story is Amanda Monk's. She's the borrower facing the biggest hurdles. She came to them with, in her own words, downright horrible credit.
And in today's world of automated underwriting, that's usually where the story ends. But it didn't.
No, the team didn't just say no. They gave her a step-by-step plan to fix her credit in record time. This is where they go from just being a lender to being more like a financial coach. They invested time in her before she could even apply.
And then the execution, once her credit was fixed, was impressive.
Incredibly fast. She got a pre-approval in 24 hours, and they closed the whole loan in 3 weeks. And the source notes that she didn't even have a realtor. So the team, specifically someone named Kelly and her staff, had to step in and manage everything, which is way beyond the normal scope of a lender.
And that specific story really ties back to that 247 claim we talked about at the beginning. The praise for Kelly Ardito's team specifically mentioned them answering calls and texts after hours and weekends. That's the proof. That's where the claim meets reality. When things get stressful, that availability is everything.
It really is. It shows that a lender's value isn't just the rate. It's the knowledge and the sheer dedication they bring to get you through the process, especially when it gets messy.
So what does this all mean? The biggest takeaway for you is the value of knowing your options. A successful mortgage search means understanding the whole spectrum, from FHA and VA loans with their costs like MIP to the more flexible jumbo and conventional options.
And this deep dive really confirms the value of partnering with a lender that has that kind of longevity since 1996 and a serious commitment to being available. They keep hammering home those tangible benefits. Low down payment options, like that 96.5% financing, and real help with your closing costs.
We started out by flagging that big regulatory warning from the CFPB about getting rid of the GSE patch, that bit of flexibility in the debt-to-income calculation.
Right. And the source warns that change will have a tremendous effect on people's ability to get a loan. So this leaves us with a final provocative thought for you to consider. If that hard deadline arrives and the GSE patch is gone and those debt-to-income rules get super strict, which borrowers do you think get squeezed the most? Will it be first-time buyers who need every bit of leverage they can get, or maybe people trying to refinance to get out of debt? Understanding who's most at risk is how you navigate the road ahead before the rules change on you.